First Republic Bank failed because it had a high level of uninsured deposits, a less valuable loan book and investment portfolio, and due to the US Federal Reserve Bank raising interest rates to control inflation. First Republic grew rapidly through deposits from wealthy individuals and companies, which it used to make large loans, including jumbo mortgages, when interest rates were at historically low levels, in hopes of them convincing customers to expand into more profitable products like wealth management. But its strategy made it more vulnerable than regional lenders with less affluent customers, since US deposit insurance only guarantees $250,000 per account. So while First Republic's wealthy clientele helped it grow deposits rapidly, it may have also contributed to its downfall. The bank's core customer base was very wealthy clients who rarely defaulted on loans. But that also meant many held much more than the $250,000 deposit limit insured by the FDIC. The failure of First Republic, which had January to March 2023 outflows of more than $100 billion, marks the demise of a third major US bank in just 2 months, after two other major banks, Silicon Valley Bank and Signature Bank, went under earlier this year. The Federal Deposit Insurance Corporation, or the FDIC, announced the closure of First Republic and the sale of most of its deposits and assets to JP Morgan Chase. JP Morgan CEO Jamie Dimon confirmed that his firm won't retain the First Republic name and will not take on any of the bank's corporate debt or preferred stock, meaning that First Republic shareholders and debt holders will be wiped out, as is typical in a bank. First Republic Bank was founded in 1985 by James "Jim" Herbert, son of a community banker in Ohio, with a focus on providing big loans at cheap rates. In 1986, First Republic went public on the Nasdaq Stock Exchange, and in 1992, it was listed on the New York Stock Exchange. In 1994, First Republic acquired Silver State Thrift and Loan and converted it to First Republic Savings Bank. In 2003, the company acquired the money management firm Starbuck, Tisdale and Associates. In 2006, First Republic merged with Bank of Walnut Creek. In September 2007, First Republic was acquired by Merrill Lynch for $1.8 billion in cash and stock. In July 2010, Bank of America, which acquired Merrill Lynch and thereby acquired First Republic, sold First Republic Bank to a group of private investors, including Colony Capital, General Atlantic, and Chairman James Herbert and former CEO Catherine August DeWilde for approximately $1 billion. In December 2010, the bank once again became a public company via an initial public offering, raising $280.5 million US. In November 2012, First Republic acquired Luminous Capital, a wealth management firm with $5.5 billion in assets. From then on, and as we shared earlier, First Republic grew rapidly through deposits from wealthy individuals and companies, and it used those deposits to make large loans, including jumbo mortgages, when interest rates were at historically low levels, in hopes of then convincing customers to expand into more profitable products like wealth management. And this, experts believe, is what caused its recent downfall. The failure of First Republic Bank had a significant impact on the banking industry. Stocks of all major banks and even those of blue-chip tech giants like Apple and Microsoft experienced immediate and sharp downturns soon after First Republic Bank's collapse. First Republic became the second largest bank to fail in American history, following Washington Mutual, which collapsed in 2008. And that bank was also acquired by JP Morgan Chase. The collapse of First Republic and other banks like Silicon Valley Bank and Signature Bank underscored how the effect of risky decisions at one bank can quickly spread into the broader financial system. The failure of First Republic also raised concerns about the stability of other banks catering to wealthy clients. However, analysts do not expect the banking system to be affected by any more large bank failures. The deal between First Republic and JP Morgan Chase protected all of First Republic's depositors, but JP Morgan did not take on any of the bank's corporate debt or preferred stock, meaning that First Republic shareholders and debt holders were wiped out, as is typical in a bank failure. What is also typical during times of extraordinary crises is that many small and medium-sized players fail, and a few big players like JP Morgan Chase in this case become even bigger. When a bank is at risk of failure, the government intervenes to prevent potential global contagion and protect customers' deposits. The Federal Deposit Insurance Corporation, or the FDIC, is responsible for insuring deposits up to $250,000 and resolving failed banks. The FDIC can take over a failed bank and sell its assets to another bank, as it did with First Republic Bank. The government can also take steps to shore up confidence around the larger banking system, as it did after the failure of major banks in March 2023. The government can also implement strong supervision, high capital requirements, and effective regulation to prevent future bank failures. When a bank fails, it can have a ripple effect on the economy as it erodes confidence in the banking industry and makes borrowing harder, which can curb spending and ease some pressure on prices and the labor market. The Federal Deposit Insurance Corporation, or the FDIC, plays a critical role in bank failures. As the insurer of the bank's deposits, the FDIC pays insurance to the depositors of failed banks. In the event of a bank failure, the FDIC acts in two capacities. First, as the insurer of the bank's deposits, the FDIC pays insurance to the depositors up to the insured limit of $250,000. And second, as the receiver of the failed bank, the FDIC is responsible for resolving the bank's affairs, including selling its assets to another bank or liquidating them. The FDIC's primary objective is to maintain financial system stability and public confidence. The FDIC uses a number of methods to resolve failed banks, including deposit payoffs, insured deposit transfers, purchase and assumption P&A agreements, whole bank transactions, and open bank assistance. In the unlikely event of a bank failure, the FDIC acts quickly to protect insured depositors by arranging a sale to a healthy bank. The March 2023 failures of Silicon Valley Bank, Signature Bank, and Silvergate Bank were the biggest comedy show in the banking industry. It was a real-life episode of The Office, but instead of a paper company, it was the collapse of three innovative and tech-savvy banks. Silicon Valley Bank, known for its lending to tech startups and companies, decided to invest in the latest and greatest digital currency, Dogecoin. The bank's executives thought it was a no-brainer investment considering it had Elon Musk's stamp of approval. However, it turns out that memes don't always equal profits, and the bank lost its entire investment when Dogecoin plummeted to zero. The bank's CEO was last seen wandering around Silicon Valley muttering, "But it was a meme coin." Signature Bank, which had made a name for itself by providing services to small and medium-sized businesses, went all in on a new business trend, NFTs. They even started accepting NFTs as collateral for loans, but unfortunately, no one told them that the value of NFTs is about as stable as a Jenga tower in an earthquake. When the market for NFTs crashed, the bank was left holding a bunch of worthless digital art pieces and was forced to close its doors. And Silvergate Bank, a leader in digital currency banking, was the biggest irony of them all. Despite being at the forefront of the digital currency revolution, they forgot to update their banking software and it all fell apart. It's like one day all of their customer account balances suddenly displayed an error 404 funds not found. The bank's IT department spent hours frantically trying to fix the issue, but they ultimately concluded that they had lost all their customers' deposits. The bank's CEO was last seen drinking heavily and muttering, "We were supposed to be the future of banking and we can't even keep track of our customers' money." In the end, the three banks' failures were a lesson to everyone in the banking industry. It doesn't matter how innovative or tech-savvy you think you are, there's no substitute for sound financial practices. And of course, it's always good to remember that just because it's your favorite meme doesn't mean it's a good investment. The consequences of the 2023 bank failures on the US economy were significant. The Federal Reserve anticipated a mild recession in late 2023 due to the potential economic effects of the recent banking sector developments, or declines if you want to be brutally honest about it. The failures also increased the risks of a global recession, as many economists expected a significant downturn in global economic growth this year, even before the failures, because of an unexpected pullback in spending and investment in the US and Europe amid climbing interest rates. And a survey found that recession odds for 2023 hovered at 64% amid bank failures and higher rates. The March 2023 failures of multiple major US banks triggered a sharp decline in global bank stock prices and swift responses by regulators to prevent potential global contagion. These failures were due to risky business strategies, including investing in US Treasury securities, which had been paying low interest rates for several years, and significant exposure to cryptocurrency. To put things in a bit of a perspective, the total assets of just two of these failures, Silvergate and Signature, were almost the same as the total assets from the 25 banks that failed in 2008. Quite obviously, these catastrophic American bank failures had ripple effects on the global banking sector. Banks around the globe lost sizable chunks of their market caps after the bailouts in the US happened. Credit Suisse was killed by the global ripple effects of just two US bank failures, Signature Bank and Silicon Valley Bank, and became the latest ripple itself in the industry, making that mess a crisis for the banking world. The reasons which are leading to this shambolic collapse of the banking system are balance sheet losses, scandals, and also customers that have been fleeing for 2 years in a row now. Ultimately, these failures are raising questions about federal oversight and response because, after all, it was risky business strategies and weak risk management by very powerful yet very irresponsible institutions and individuals that brought forth and continues to exacerbate this global crisis. A crisis that is disproportionately and devastatingly affecting some of the poorest and least privileged of us. According to a report, link in description, by Business Today, 186 banks in the United States are at risk of failure or collapse due to rising interest rates and a high proportion of uninsured deposits. However, it is important to note that there are often warning signs leading up to a bank failure, and regulators keep a close eye on banks and step in when necessary to prevent failures from happening. But the failures of big banks like Silicon Valley, Signature, and now First Republic only highlights the risks of banks that have significant exposure to cryptocurrency and risky business strategies. And while there is no definitive list of banks at risk of failure, it is important for US regulators to monitor the banking industry closely to prevent potential failures from having a significant impact on US customers, employees, and the US and world economy as a whole. That's all we have for you today, but please check out one of our other videos. And while you are here, why not subscribe and leave a comment? Thank you for being with us today, and we'll see you in the next video, my friend.